It's the 27th of April. It's a Monday, and we have a new Axios report about a potential deal to reopen the Straits of Hormuz. But oil prices are up, not down. The tech rally continues in Asia. TSMC, though, pay attention to that chart. It faded pretty sharply into the close. And the Fed, the BOJ, the ECB and the BOE will all meet this week. And it looks like Kevin Warsh might also be confirmed. The bond market is going to have a busy week, Tom.
European futures were pointing to a slightly brighter session, but that has faded on those higher oil prices that you point to, Guy. Currently, European futures pointing currently flat, essentially, looking to add just 3 points so far. We'll see how that adjusts, of course, as we consider what is happening in terms of the reporting around the Strait of Hormuz. US futures, after a fresh record on Friday for the S&P and the Nasdaq 100, currently S&P futures pointing to losses of 0.1%. Brent, and this again is the importance, close to 2% is the gain, currently above 107 on Brent, with Goldman raising their forecast for fourth quarter oil. The countdown to opening trade starts right now.
Welcome to the programme, everybody. 7:01 here in London. This is the opening trade. Welcome to Monday, another Monday morning where we take stock of the weekend's developments and ask what they've done to risk appetite. And I was all sat to sit here. I was ready to sit here talking about the uptick in risk appetite as a result of this Axios report. But that seems to have faded a little bit, so we won't maybe dwell too much on it. But suffice to say, it's been a quite volatile 24 hours when it comes to risk appetite, because initially, when we saw trading in Asia, actually we saw a drop in risk appetite on the collapse of the talks. Then there was this Axios report that suggested the Iranians had submitted a new offer to Washington, and we saw an uptick in risk appetite. But that doesn't seem to have lasted too long. Oil prices are at 107.38. That is the Brent price. And if you dug a little deeper into what's been going on over the weekend, it already seemed clear that President Trump had said we'd received something new from the Iranians and it's not enough. So I'm not really sure why the market dwelt too long on this kind of news line. Yeah,
it didn't last that long, did it? So it's a Monday morning, so we get an Axios report. It tells us that there is a new effort to reopen the Straits of Hormuz. I think the market's getting a little bit kind of weary of all of this. It's interesting. So oil prices are up this morning, and that seems to have taken the steam out of US futures, certainly seems to have taken the steam out of European futures. We'll get on to tech in just a moment. Tech faded pretty sharply in Asia towards the end of the session too. So it feels like the market maybe once again, well, no, actually maybe this is a new reaction, is, as you say, fatigued and looking through.
And markets are also playing out those different scenarios. We are now out of this as a short-term response. This is a short-term conflict scenario. There are the worst-case scenarios that central banks, other economists and investment banks have mapped out as well. We're not quite in the worst-case scenario, but we're certainly edging towards the middle-case scenario, which is this is becoming a long and drawn-out event. And that's why you're getting the likes of Goldman Sachs and others raising their forecasts for Brent on this expectation. So really, we have to look through what is happening in the Middle East right now, at least right now, and look ahead to a week with the centrality around central banks, and also whether or not, because the key theme for the markets has been that AI trade and the semiconductor trade. You're still seeing that in the Asian session, and whether we got validation this week with the earnings story.
And just before we move on to tech then, because I know that's where we're going next, we'll just point out, yes, oil prices are higher in the moment, but they're also higher on the December contracts, which I think is really interesting in terms of those mapping out where this goes from here conversations. The December contract actually at risk of touching a new all-time high, so we'll keep that under review. Shall we move on to tech then?
Just a massive week in terms of earnings with tech front and centre. So you're getting most of the Mag 7 reporting. Of course, Nvidia is later towards the end of May, but you're going to get the Amazons, you're going to get the Microsofts, the Alphabets, and Apple as well on Thursday. So for those businesses, the focus is going to be on cloud. To what extent, again, the investments around CapEx are going to be actually paying off in terms of the demand that they're seeing as the driver from AI. And whether or not they're going to start to sound a little bit more cautious on CapEx as well. Because the balance sheets of these companies and free cash flow is now looking a little bit more constrained.
It was interesting. You just got the Oracle debt over the line, which was a big sort of story last week. How does the market react if these companies start saying, we're not, this isn't a slowdown, but we're not going to do the big kind of jumps in CapEx spending that we've done over previous quarters?
I'm not sure what the nuance is that the market is looking for here, because they want enough CapEx to be reassured that there's a lot more to do in the AI story. The build-out is still in place. It's all still valid. But at the same time, they don't want so much CapEx that it stretches that free cash flow story that you've been mentioning.
And it's fascinating. If you look at Amazon, their free cash flow is back to kind of 2022 levels. Meta have about $4 billion in terms of free cash flow. That is sharply down as well on that spending. So how do you thread that needle, to Anna's point? But earnings are looking, the projections for Q1 earnings are 19% for the Mag 7. So obviously, again, above what you're seeing across the S&P 500 generally. But 19% is pretty healthy if they meet that.
Does the market care about the Magnificent Seven anymore? Or is it chip stocks now? Or is it optical stocks?
Well, it seemed to care over the last few weeks, didn't it? I mean, the Mag 7, some of the performance there, some of them are up by 25% in a month. These are giants, aren't they? But I mean, maybe they also care about the chip story.
Are they just signals for what else is happening? Is what I care about. They got pretty beaten up, so did they come back? If you look at the multiples, they've improved. Do you buy them on the back of that? Have they got cheap? There's all kinds of arguments swirling around. But the action is elsewhere.
Yeah.
And are they just a signal for what happens in the chip sector about what demand is going to look like? And what demand signal they're delivering is the most important narrative that comes out.
18 straight trading sessions of upside for the semiconductor index, the Stocks index.
And we're going to talk to Patrick Armstrong, who I know is one of many investors who's really keen on some of these high-bandwidth memory companies that, by his estimation, and by that of many, are still not expensive.
But why are they not expensive?
Back to that conversation.
Cyclicality debate. Kevin Warsh, we might get a vote this week. So he could be. It looks like we're clearing Wednesday potentially. So it looks like we're going to clear the Tom Tiller's block on his nomination. That looks like it's happening. That kind of was confirmed over the weekend. Tom Tiller's was talking over the weekend. So that looks like it's been kind of ticked in the box. So that's quite an interesting development. Central banks, lots of them. What have we got? The BOE, we've got the Fed, we've got the BOJ, we've got the ECB coming through. My latest calculation, the team's latest calculation, Fed no cuts, ECB 2 hikes, BOE 2 hikes, BOJ 2 hikes.
In the year?
This year. Yeah. Is that real? I don't know. This week it feels like they're just going to sit on their hands and say we don't have enough information. We can't figure out what's happening.
I think it is really interesting, the dynamic in bond markets this week, because on the one hand you've got the Warsh story. Some of that was priced in on Friday, but there would be a bit of a downward pull on yields if we thought that would mean that he was going to be cutting, more likely to cut interest rates. On the other hand, if the message we're going to get from these global central banks is, whoa, inflation is, we're really alert to the inflation risks, we're very worried about what's going on in the Middle East, but we're not going to do anything this week. Is that going to leave room for markets to worry about inflation risks and therefore higher yields?
And how much divergence are we going to see between the Fed versus the ECB and the BOE, with the challenges around growth more acute, arguably, in the UK, and we're seeing that in the data, and in the Eurozone as well.
But these are the central banks that are hiking.
Going to start to come through.
But the central banks, they're priced to hike, despite the growth risks.
Therein lies the tension. And this is why it's going to be so deeply uncomfortable for members of the MPC and the BOE.
Will they justify the market's pricing? Will they say they agree with the market's pricing? Because some of them, the Bank of England, for example, has said the market is pricing in too much. At least some weeks ago we heard that message.
The governor. At least the ECB got inflation back to target. Most of the other central banks haven't, so of the major ones, certainly.
Does the ECB come out more credible then? Is the ECB currently the more credible central bank because it got it down to 2%?
Well, it started from a good place, didn't it, I suppose?
It was probably an easier narrative to deliver upon.
Yeah.
Anyway, we've got some great guests to talk about all of this. Victor Yorton is going to be joining us from BNP Paribas, Global Markets, Credit and Equity Derivatives Strategy, Global Head. Got there in the end. Patrick Armstrong, Karumi Wealth, CIO, joining us as well. And Ralph Goulder, Sereact, co-founder and CEO, joining us a little bit later. We're going to be talking about robotics. OK, those are some of the guests coming up on the show this morning. Here's what else you need to know, though, throughout the next couple of hours. An attempted attack at Saturday's White House Correspondents' Dinner is spurring fresh questions about the security around President Trump. The armed attacker, identified as 31-year-old Cole Thomas Allen, ran past a security checkpoint at the Washington Hilton before being apprehended. Administration officials say they believe he was targeting US officials, including Trump, who faced a pair of assassination attempts in 2024. On the back of this weekend's events, King Charles and Queen Camilla are set to arrive in Washington for a 4-day trip to the US, the first British state visit since 2007. Ties between the nations are at their lowest point in decades, with Prime Minister Keir Starmer under fire from President Trump for refusing to join America's initial strikes on Iran. The King is expected to address a joint session of Congress and attend a White House banquet. Adidas has reason to celebrate today after a record-breaking London marathon. Kenya's Sebastian Sawe and Ethiopia's Yomif Kajachat
Both ran in the brand's new ultralight $500 racing shoe as they shattered the 2-hour barrier. So it surged ahead in the closing stretch to win in 1 hour, 59 minutes and 30 seconds, a new course record. Kejelcha finished just 11 seconds behind in what was his first ever marathon.
Coming up on the programme, traders warn the worst of the oil shock is yet to come as the Strait of Hormuz remains effectively closed. We will discuss the risks ahead. Plus, Wall Street banks are taking divergent paths in the race to master quantum computing. We'll dive into today's big take story. Up next, we'll be joined by Mark Dowding, fixed income CIO at Blue Bay Asset Management. Lots to talk about when it comes to Kevin Warsh, when it comes to the developments in the Middle East over the weekend. What is the strategy from here for the rest of the year? IB plus BBTV Go is the function to use if you want to get involved in these conversations. This is Bloomberg. Welcome back to the programme, everybody. This is the opening trade, 7:14 here in London. We're pretty flat on our overall expectations for where we head at the start of trade. And I'll just point out that we go a little higher on the oil price, 107.55 now on Brent, up by just over 2%. Let's talk about what's going on in the Middle East then. Iran has reportedly given the United States a new proposal to reopen the Strait of Hormuz and end the war. The Axios report, which cites a US official and 2 people with knowledge of the matter, says the offer calls for extending the ceasefire to allow time for Washington and Tehran to work towards a permanent end to fighting. For more, let's bring in Bloomberg's Jumana Basechi, who's in Dubai. What more can you tell us about this proposal, Jumana? Because it seemed to me that President Trump on Saturday said, yes, we've received something new from the Iranians, but it doesn't go far enough. So what does this add to our understanding?
Yeah, well, there are a couple of important things to highlight here. The first is that second round of Islamabad talks did not take place this weekend, even though the U.S. side were ready to send their envoys. So that's point number one. Point number two, from what we understand, what Iran are presenting to the U.S. via mediators, and in this case via Pakistan, is not a final peace agreement. It is, in fact, the conditions that they are setting in order to continue negotiations. So there's a little bit of a distinction there. And yesterday, Iranian media, this is Tasnim, the state official, semi-official state media, were citing what those conditions are, including a new legal framework for Hormuz, lifting the blockade, compensation for damage, and guarantees against further military action. No discussion whatsoever of the nuclear file, which echoes what Axios also reported as well this morning. And it's important to note here as well that the U.S. have not responded to any of this. And number one, Trump has also signaled in a Fox News interview yesterday that he has no intention whatsoever to lift the U.S. naval blockade because he seems to think that it is working. He actually said that in the next 2 to 3 days, what you're going to see is Iranian storage capacities being filled up, after which they will be in an economically very weak position. The thinking there, of course, is that once they come to the table with a weaker economic hand, then you can extract more concessions. And so one of the questions around this suggested proposal coming out of Iran is why would the U.S. accept it, given that it would remove one of their key points of leverage perhaps later on when it does come to the nuclear file. So nothing yet from the U.S. side. As things stand today, though, the strait is still effectively shut. There are no vessels passing through, very limited transits actually going through, still because of the risk of danger. And the second point is there hasn't been a lot of progress in terms of the two sides coming together. And the Iranian foreign minister has continued his diplomatic push around the region. Yes, he went to Islamabad, he went to Oman, he went back to Islamabad again. And today he's actually reportedly meeting with the Russian President Putin. And so there's no indication, at least from the Iranian side, that they are going to yield on any of the terms that they put forward. And indeed, from the U.S., we are hearing conflicting narratives coming through from President Trump himself. But what's become clear is that from a sequencing perspective, you would almost need to lift the mutual blockade of the strait in order to proceed to the second round of discussions. And at this point, it doesn't seem to be the case that we have enough in here to lift that stalemate between the two sides.
Jumana, Great update, comprehensive update. Thank you very much indeed. Jumana Pasechi joining us out of Dubai. Mark Dowding, fixed income CIO at RBC Blue Bay Asset Management, joining us around the table this morning. Good morning.
Morning.
This is phrase in markets, which is it's better to travel than arrive. Does that apply to the current scenario?
Look, I feel at the moment there's a sense in which markets are fitting a narrative to a price action. It seems like we're in a world where equity markets are looking at things very much in the sense that the glass is half full. However, I think the thing that we would stress here is, look, we've faced a large supply shock, a large stagflationary supply shock. Even if there is a peace deal relatively imminently, there's still going to be a lot of economic disruption here that I don't think has really been properly factored into on the part of markets. It almost reminds me, it has the echoes of what we saw in the run-up to COVID actually landing on our shores. We saw in Jan and Feb of 2020 this wave of the virus heading our way, but it was only when it landed, it was only when it disrupted our lives that it really had a greater disruption in financial markets. And I do worry that something similar like that could be true here, particularly when we bear in mind that this idea of peace isn't a given.
We don't know. So maybe it is better to travel than arrive, because once we arrive, we're going to get kind of a big shock coming through. But let's talk about the travelling phase that we're in at the moment. Are equity markets are doing tech, and other markets are doing oil. And I'm just like, do the Venn diagrams overlap? Because it feels like the tech story is driven by massive AI hyperscaler spending. We were talking about it just a minute ago, and the rest of the world's focusing on oil. Do those two circles overlap in any way? And if so, when does that happen?
Yes, look, they do overlap. All of this is interconnected. And ultimately, if you end up with energy prices being elevated, that's not great news for running data centres, is it? I think the one thing that I would stress and emphasise here, though, is actually there's a big disconnect between what's happening on the ground in the US relative to what's happening in the rest of the world. I'd infer that the tech story that you sort of mentioned there is very much a US-led story. And having been in the US in Washington last week, there's a real sense in which the impacts of the Middle East crisis are not really being felt in nearly the same way in the States as they are in the rest of the world. So you can make an argument why you'll see a strong earnings when it comes to S&P, and we're in the middle of that earnings season this week. That means that the S&P can trade relatively well, but I would infer that outside of the US, European economies, Asian economies are going to be much more disrupted. If you end up with an inability to fill up your car at the pump, if you end up with big disruptions in helium, on chips, if you end up with disruptions on aluminium, on fertiliser, creating a food crisis, all of this is going to be felt in a much more explicit and tangible way outside of those US shores. So that's where the intersection or the disconnect sits as far as I'm concerned.
And Mark, good morning. You have a little rule of thumb as to how this is going to play out for Europe. You say for every week that the Strait of Hormuz is closed, this can add 0.1 percentage point to inflation and subtract the same from GDP. Does that get real starting now? We're already seeing this in inflation, aren't we?
Yeah, we are. And I think the thing that I'd emphasise here is that it was only really in the course of the last week that we actually saw the last of the Middle Eastern tankers reaching sort of ports in Asia. So it's only now that we're really kicking into that supply disruption. Obviously, we're in a world where there's a lot of economic scenarios. It's difficult for economists really to figure out what this really means. And so we're all scrambling here to an extent. But the point to emphasise is that every day this is shut, this problem is getting worse. We're now short of $1 billion of oil, billion barrels of oil, I would say, since the start of the crisis. So every day this carries on. It's hurting Europe, it's hurting Asia. In the US, they can long this out. This could drag on for a number of additional weeks, and in that sort of sense, you're only seeing a bigger supply here. And if this isn't fixed inside the next month, we are going to be looking at recession in Europe. I think that becomes unavoidable.
OK, recession in Europe if this goes on for the rest of for a month. Add into that mix then, which is already complicated enough, a new Fed chair, Kevin Warsh, and this inclination to cut, which seems to be the baggage he brings with him, although he professed to be very independent when we heard from him. Add in what that means. What does that mean, do you think, for global markets?
Well, I think that Kevin would like to cut, wouldn't he? I mean, he was installed with that sort of remit. But I think the reality is that US rates are going nowhere for the foreseeable. the barrier to actually hiking, I think, is very high in the US, and the Fed will reiterate that they would see that rates are currently at or slightly above a neutral rate. So I can't see the Fed hiking, but we think that inflation in the US is going to go up towards 4. Against that sort of backdrop, you're not going to be talking about rate cuts until into 2027, I wouldn't have thought. Elsewhere, we also see a material inflation overshoot. I don't think any central bank is going to do anything this week, but do expect the ECB to be teeing up a rate hike at its meeting.
To be clear, you think the Fed stays on hold through 2026?
I think on hold through 26, I think you need to get past this inflation shock.
Yeah.
And I think the thing that I'd say here is that the damage to infrastructure, the damage to supply chains is something that is going to keep oil prices elevated for the next 6 months. Even if you end up with an end to the Hormuz crisis, you're only going back to somewhere between 70 and 80 on oil. Also, look at food. There's going to be food inflation. Every tonne of fertiliser that's been missed equals 50 tonnes of food that doesn't get produced. That's creating things like famine in places like Bangladesh. I think in the global south, this is not an energy crisis, it becomes a food crisis. And I don't think that these sorts of factors have been fully understood. So you are going to see pressure on food prices, pressure on aluminium, pressure on many commodities. And as that washes through the global economy, that's what's going to keep inflation elevated for a time, which is why, as a bond investor, I actually think that inflation-linked bonds actually are the place that you want to be hiding right now.
Inflation-linked bonds, and you would apply that metric to the UK as well. Is it? I mean, how vulnerable are gilts in this scenario?
Look, I think that gilts are vulnerable because the UK is an economy that tends to have bigger inflation shocks. This is where things overshoot. I mean, I think the IMF was alluding to that last week. And so we could see inflation in the UK well above 4%. And again, I don't think the Bank of England want to hike, but they may be dragged towards a hike. The reality, though, is that there'll be an inflation phase, but then we're going to see the other side of this, which is the growth shock. This is about stagflation. It's going to hurt growth. And so from that perspective, I would say that rates markets have already corrected quite a lot since the start of the Hormuz crisis. UK rates have corrected at the front end in terms of the December contract by over 125 basis points. At the same time, you look at credit markets at their tights, you look at equity markets being held up by the S&P, and here the message is the strength of the S&P shouldn't be holding up other risk assets. But at the moment, I feel that that's the simplistic narrative.
I don't know whether to ask you about gilts or whether about... So OK, let's go to that thought. US equities are outperforming European equities. But European equities are also moving higher. You think they should be moving in quite significantly different directions?
I think there should be greater divergence here. And we've started to see that over the past week or two, haven't we? But,
so is the S&P mispriced or are European equities mispriced?
Well, I would say that European equities are mispriced here because they're not factoring in the idea that there's real tangible recession risk that we're now facing. I'd say that globally, equity markets have not really repriced to the fact that even if earnings are pretty robust, you're facing a different economic environment. You're facing higher bond yields. You don't have the tailwind of rate cuts. You don't have the tailwind of lower bond yields. And if you discount those cash flows in stocks, I do think that's a challenge to valuations, but let's face it, this is not what the S&P trades on. The S&P trades on what retail cares about, and the retail just wants to buy the dip. And so you can make a case technically why US stocks can diverge, but I don't think that narrative really holds a lot of water in Europe.
Mark Dowding, thank you very much indeed. As ever, RBC Blue Bay Asset Management Fixed Income CIO. Coming up, big tech reporting this week. To Mark's point there, we discussed the outlook for the sector and the potential ramifications for private credit in more detail. We're going to speak to Victor Short from BNP Paribas. Stay with us. This is Bloomberg.
Monday morning, how are you doing? This is what futures look like right now. We're 30 minutes away from the start of cash trading. Futures on both sides of the Atlantic have definitely faded over the last couple of hours. We saw actually some fade in the Asian session towards the back end of that as well. We have seen oil prices going higher. So the risk narrative feeling a little less positive than maybe a couple of hours ago.
Yeah, absolutely. And inflation still front and centre, it would seem, for bond markets. At least that's the direction of travel right now. We see yields in the US bond market going higher. We see yields here in Europe just edging a touch higher, only by 1 or 2 basis points, so not by a huge amount. But on Friday, we saw yields coming down a little bit, partly over in the US on the back of the Kevin Warsh story and the DOJ developments there. But that also filtered into the European bond markets. And now we see a bit of a reversal at the margin of that, Tom.
On a massive week, of course, for earnings, we count down to the names, including Meta, Microsoft, Alphabet, all reporting results this week. Investors will be watching, of course, the results closely for clues on AI demand and CapEx plans. Joining us now is Victor Hjort, BNP Paribas Global Head of Credit and Equity Derivatives Strategy. Victor, good morning. Thanks for joining us in the studio. I want to start on the earnings story, then we'll get your views on private credit. As we look ahead to what's happening in the tech space and the numbers crossing this week, we're seeing some evidence that free cash flow is starting to be squeezed for some of these big names, and in fact that CDS, or at least the cost of insuring against default, is starting to rise as well. Are the so-called fortress balance sheets of tech, do you think we'll get evidence that they're starting to look a bit more vulnerable?
I think the big story is, are they going to continue to spend? The hyperscalers, are they going to continue to spend the way they have for the past 3 quarters? And there is a chance that this will be the first quarter, maybe since the second quarter last year, where we will not see a ramp up in CapEx plans, maybe just unchanged. And that may not be, a big switch towards fiscal discipline, if you like, but it could be a small change in the narrative towards something that appears more like fiscal financial discipline. And I think it'll be taken extremely well by credit markets because it sort of suggests that there is less bond supply in the pipeline. It will probably be taken pretty well by equity markets too. Do you think we're over the hump in terms of issuance, or at least 2026, end of 2026, that issuance story becomes less acute for these hyperscalers as they build around infrastructure? Yeah, so I mean, we are obviously looking at hundreds and hundreds of billions worth of spending and issuance, but I think there was always this tail risk that it could be much more, because if you're building the technology of the future, maybe paying 4 or 5% interest rates isn't, it's a price we're paying. But now I think you're getting the signals from the markets that, especially equity markets, are not so comfortable with big spending anymore. And I think that is an incentive for some of these companies to become more financially disciplined.
Yeah, and Victor, good morning. What is the not too hot and not too cold CapEx story that we should be looking for out of these hyperscalers? Is that the way to think about it? Spending, but not too much?
I think it is probably enough if they keep to existing plans, saying, confirming that what we have been saying for the past few quarters is about right, and then proving that with some earnings growth on top of it.
OK, and then for the private credit sector, if we think about what's at stake there, what do we need to see? We need to see software companies proving that they can embrace AI quickly enough to fend off the more sort of generic AI challenge. And that shores up the private credit sector. Is that what you're looking for evidence of this week?
Yeah, I think that's the other interesting story. Are we going to see any more visible evidence of software disruption? For software, I think it really is a race against time, right? So if you look at private credit, which has been funding much of software, it has a debt maturity wall in 28, which the market will start to focus on next year. It has a slow burn in terms of the liquidity in some of the funds that are funding, the sector as well, which is also pointing towards 27, 28. So there is a bit of a race against time that between now and then, the companies need to figure out an antidote towards AI disruption. And that, I guess, is going to be what the big focus is going to be over the next few weeks as they report.
Our last guest thinks we're heading towards a recession potentially here in Europe. The view from Blue Bay. If we get a recession in Europe, how does European credit react? How mispriced is European credit? Where is the pain going to be felt first, and where does it ultimately get to?
Well, Europe isn't priced at all for a recession. Maybe it shouldn't be, but the asset class that would have most scope to reprice in that scenario with European high yield, it's a very cyclical asset class. It's an asset class that also doesn't like high oil prices. So that would typically be where you look for vulnerability if you're going to start to price in a recession. I guess personally don't think that it's as imminent perhaps as others. Is
the risk growing? Like every day that the Strait of Hormuz remains closed and oil prices remain where they are, presumably the risk has to grow.
No, that risk probably has to grow, but I think there are some important lessons from the tariff wars of last year, which were, I think, very similar in the sense that, a very left field risk introduced by a Trump policy, a risk that most people are not used to and can't really quantify, and so they assume the tail risks are enormous, and then 3, they cut all their risk and exposure to very, very low levels, and then 4, the tail risk doesn't materialize, and so there's a scramble to get risk back on. That, I think, is where we are right now. This
is that the right reaction?
I think it probably is the right reaction, in the sense that, there's a lot of shock absorbers left in both the credit market and the overall economy. I mean, the U.S. economy has shock absorbers from AI capex and from, this obvious wealth effect. Yep. But Europe is also going to see much more defense spending as a result of this. So I think there are shock absorbers here that we shouldn't underestimate.
It just feels like that, the tariff story 2022 and that as a heuristic. I mean, the difference is that one big difference is that the economic fundamentals are looking quite different, and the consumer's looking a lot weaker, and the cash balance sheet on households is looking a little lower, and so I guess that is another concern for those who are looking at this run up that we've seen. In terms of your comfortability, how comfortable you have been with the run up, particularly in the semiconductor stocks that we've seen in the last 18 trading days. Does that have further to run? How comfortable are you with the upside that we've seen for tech and particularly hardware?
That was a big sigh, Victor.
Yeah. Do you know what? That's my question.
Come on, it's only Monday.
Exactly. Look, the capex plans are going to have to remain in place, and and semiconductors are the main beneficiaries of that. And
so you said earlier the capex plans start to peter out, right? They start to stabilise. Yeah. So what does that mean for the chip stocks then?
It probably suggests that. That there will be that there is room for negative surprises emerging in that space. Yeah.
Let me ask a bit more about the shock absorbers you talk about for the European economy. Why you're not so convinced by the more doom laden recession forecasts of some, and one of them is defence spending. I mean, yes, we've seen Germany ramp that up a lot. Is this going to be enough, and is it going to have an economic multiplier that really delivers for growth in a way that makes up for what is being lost?
So, I mean, if you take a step back, European economy, there is a room for sluggish surprises, and then there are recession surprises. I think sluggish surprises are, very real and realistic, but maybe recession risks are a bit lower. So shock absorbers are, we're starting from a pretty low unemployment rate. So jobs protect people. We're starting from a point where corporates are not very levered. They haven't been investing as much, which is a problem for the economy, but not for the balance sheets. And then you got that defense spending, which I assume has to ramp up and maybe also over time now become more Eurocentric than perhaps was the case before, because maybe there is an emerging lack of trust in your military partners globally.
Yeah.
Victor, nice to see you. Thank you very much indeed. A lack of trust. Victor Hjorth, BNP Paribas Global Head of Credit and Equity Derivatives Strategy. Thank you very much indeed. It's a big week for central banks. Some analysts are, though, keeping their eyes all on earnings.
Right now, I'm not worried about rates. I don't think that's going to be an issue for the market. Valuations are totally fine here, 21.5 times earnings, given the earnings picture. And that's been our thesis all year. We haven't wavered on that, right? That this earnings recovery is a lot stronger than people think.
He's positive. Mike Wilson, Morgan Stanley's chief US equity strategist and CIO. Plenty more coming up on the earnings picture next. This is Bloomberg. Monday morning, good morning. When I had my first look this morning at TSMC, it was up kind of circa 6%. It gapped higher at the open, really big move to the upside. But as it came into the close, it faded quite sharply. And I think it finished up circa 3.5%. And what you've seen around the world has been that fade. Oil prices have moved up over the last few hours. Nasdaq futures are now basically flat. Europe is now basically flat, Tom.
Chip stocks have performed pretty well in Asia.
Yep.
And to your point, they have faded some of those earlier gains, but nonetheless a positive session for the Kospi, for the Nikkei and for the Taiwanese Stock Exchange as well, up 1.8%. So another decent day, despite those earlier gains being faded to some extent. That drive around AI, of course, ahead of a massive week of tech earnings. Let's bring in Bloomberg senior market strategist Neil Campling, and let's start with the session out of Asia today, and then we'll look ahead to the earnings story later this week. What are the drivers? What do you take from the session in Asia today with some of those key names back front and centre for us?
The semiconductor trade, which we've talked a lot about, obviously is fueling the rally in terms of AI in tech and the semiconductors. Now, in Asian tech, it's even more the cyclical part of the semiconductors. So if we look at Samsung, Hynix and TSMC, it's very much in terms of the cyclical element of tech. The valuations look fairly attractive relative to some of the global peers. So there's money chasing after those assets. And of course, this week, we'll get the full release coming out of Samsung as well, when we're likely to see probably a 600% increase in operating income. We're likely to see...
Did you say a 600% increase in operating income?
600% increase is expected.
For Samsung?
Yeah. Because of the memory trade within Samsung's earnings. So, estimates are very wide in terms of where they could come in. But there's some triple-digit expectations for a lot of the key metrics coming out.
Was the Asian rally a reaction to Friday's move in the States, or was it something new?
Nothing new. It's just a continuation of what we saw last week. Now, to see a stock like Intel gapping up clearly 25%. There's a smaller cap stock in the US that was up 75% on Friday after earnings. A company called Max Linear. There's chasing around this narrative is very narrow. So you have to kind of follow that momentum trade until we talked middle of last week about the stocks reaching an all-time record in terms of consecutive days. It's continued. We've now got the RSI, the relative strength index, at 85 on the stocks, the highest since 2011. So there's lots of metrics where you'd say this should be the end of this, but it just keeps going until it...
Yeah, we've seen the hardware, the chip story doing really well. We've also seen a broader rally in some of the other Mag 7 as well. And I'm exhausted just looking at the list of names that are going to report this week, Neil. So let's go through it. So we've got US tech results coming through this week. What will your expectations be? We've got Alphabet, Meta, Amazon and Microsoft all on one day, and then Apple follows the day after.
That's right. It's just literally, it's only $16 trillion of market cap. Yeah. In 25% of the S&P market cap in tech, reporting in that just over 24-hour period. The key messages will clearly be where are they spending on the capex, which I know you've been discussing this morning, but also are we going to see evidence coming through of accelerating top-line growth? We need to see the acceleration of top-line to justify the spend, because we're not yet, I don't think, going to see the return on investment. We're not going to see the ROI coming through yet for these massive capex expectations. The expectations are high because the semis have been reporting strong results in other parts of the market. Clearly, that capex is likely to continue, but we've got to see the top line to justify those kind of numbers. OK, so it's the link between the top line, the sales growth and the capex that's going to be important. Neil, thank you very much for joining us. Neil Campling, Bloomberg News senior market strategist, with the latest on those tech themes driving enthusiasm for tech over Friday's session and into Monday in Asia. Let's turn now to today's markets more broadly in 3 minutes on the opening trade with Paul Dobson, Bloomberg's executive editor for Asia markets. Paul, good to see you. So we were just hearing there about the tech story. Let's start on the tech story with you. What are you going to be watching for as we see this huge
huge reporting season get underway for these big US tech players. We were just hearing from Neil Campling, who was talking about how it's the link between top-line growth and CapEx plans that's going to be really important.
Yeah, good morning, Anna. That is definitely something that investors are going to be on the lookout for, with 5 of the 7 names from the Magnificent Seven reporting plenty of earnings coming out of Asia as well. It's our busiest week of the cycle coming up. So I think that is one thing that we want to see. Are they starting to make money to realize some profits from the AI efforts that are being put in place? Watch out for any announcements on jobs as well. We've seen some job cuts coming through in some of the major tech companies recently. But at 3, and I think this is interesting and important as well, where are we on the funding? It seems that narrative's gone a little bit quieter, actually, that now there's a little bit more enthusiasm in the credit sector for people lending for those data centers to be built again. That was something that we were worried about at the back end of last year, remember. Some of those funding deals, even the larger ones, seem to be getting done and going through. We're still seeing those sort of inter-Nissan deals as well, those tie-ups that are building that sort of web ever closer together. But can the market take down all of the debt that's needed in order to build out the data centers? And also, what are they going to say about energy costs, and how are they going to get around that? Because, the war in Iran has certainly put a lens back on that problem as well.
Paul, there's a lot of central banks reporting this week as well, delivering decisions. But those decisions are largely expected to be unchanged decisions. What am I going to learn? What do you think the market wants to learn from the central bankers this week? What narrative would it like to hear?
Yeah, so I think that the bond market is worried, right? Worried about what the central banks are going to do. Kind of worried if they don't do anything, and worried if they do too much as well. The central banks, sort of had been moving maybe towards more loosening, at least for the Federal Reserve at the start of this year. Now we're worried about more tightening. But if the central banks do nothing, then that could let inflation out of the bag as well and hurt the back end of the yield curve. So traders will be focusing very much on how they're going to be projecting what's coming going forwards. As you said, Guy, I don't think that anybody's expecting any of the central banks, and we do have all of the G7 central banks meeting this week. Don't think any of them are actually going to act this week. And that sort of sets off slightly different results, though. For the Fed, it's a little bit up in the air anyway, because it's likely to be Jerome Powell's final meeting potentially as chair. So we may have a new lineup come the next Fed meeting. So I will see what the individual voices have to say there. For Europe, seems like Christine Lagarde is likely to telegraph a hike in the coming ECB meeting. So that may support the euro and weigh on European government bonds, which have been underperforming under a little bit of pressure already. I think Japan as well is really important. What are they going to say? How do they manage to support the yen and give the idea that they will react, while at the same time, and the BOJ always does this, bottling it a little bit, sitting on their hands and not hiking when they have an opportunity to go ahead and do it now.
Paul Dobson, Bloomberg's executive editor for Asia Markets. Paul, thank you. Let's get your stocks to watch this Monday. Bring in Charlie Wells. Charlie.
Good morning, Tom. So it's going to be a really interesting setup that we've got going this morning with European chips, because there has been so much enthusiasm, as you guys have been talking about this morning, so much enthusiasm after the NVIDIA really beat a record it hadn't set since October. TSMC, again, earlier today hitting a record, but then tempering. So what do we get when this European ecosystem starts to open? Do we see a little bit more sobering pricing here? Because, we had that really strong outlook from BE Semi last week. But how does this look? And what is that catalyst? How are we kind of setting up for the catalyst of tech earnings this week? I think that's going to be one that we want to watch, this kind of push-pull factor here. I want to flip and talk about Leonardo. European defense, we know, really has been in focus over the past year. It had been a really strong 2025 for a lot of these companies. Morgan Stanley putting out a pretty interesting note this morning talking about how Leonardo is undervalued. They increased their price target. They brought it to a street high. Now, analysts there like a lot of the holdings that Leonardo has. They have holdings in Hensoldt, for instance. So seeing room to run here, as well as some continuity in management. Because just a few weeks ago, Leonardo got a new CEO named by the Italian government. Some questions about the trajectory of that stock, but seeing continuity there. So again, potential room to run for Leonardo. You see them outperforming their competitors this year. So again, potential room to run, even more strength there. Let's flip and talk about Ryanair, because again, with all of this news coming out of the Middle East, you start to think about oil, you start to think about jet fuel. There's a lot of attention this morning, pre-market, on Ryanair. There'd been that good news coming out of the Middle East. Does that bode well for this company? Because their margins are so thin, especially compared to a lot of the other airlines. So does that, start to trickle into the share price? Does that go up? A lot of attention on Ryanair, so we're going to want to pay attention to that at open.
Charlie, thank you very much. Charlie Wells with those stocks that we'll watch. We'll also watch the broader aviation sector, given the oil price is higher, but there's also been this report out of Axios talking about the possibility of finding some sort of peace deal. The broader market seems to have faded that story, though, quite comprehensively, because US futures are, either side of the flat line now, NASDAQ and S&P futures, looking pretty flat.
It feels like the oil price is the dominant narrative this morning. Everything was very positive when I first came in, but the oil market just crept higher. Yeah. So people are ignoring the Axios report. They're looking at everything else. They're feeling a bit more cautious going into the open.
Yeah, that caution is certainly there. The airlines, interesting stories out of the US as well in terms of other airlines on the cheaper end of the scale, or at least the budget airlines looking to the US for maybe more aid as well, more help. So we're seeing that evidence as we start to see. Mark Dowding talked about the crashing wave, potentially of stagflation, not in the US, but probably in Europe.
Yeah, he was suggesting that we could see a recession in Europe, couldn't we, if this goes on for another month, I think is the way he was thinking about it. The European market open, we'll bring you that next for this Monday morning here on the opening trade. Futures are pretty flat, actually, for European markets right now. Could be a little mixed, the start. A performance for a really busy week. This is Bloomberg.
So in Europe on Friday, the session looks a bit like this. Gap first thing, trade sideways, little blip higher in the middle, but basically finishing flat. But this was the US session. We climb into the European close, and then we climb a little bit more. It's basically up and to the right seems to be the charts that we see out of the States on an almost daily basis at the moment. This morning, the narrative looks a little bit different. So you've got that to price in for Europe. You've also got an oil price that is sharply higher once again, Tom.
European futures have faded that Axios optimism then. The report suggesting that Iran had put out a document to the US. The will they or won't they whipsawing over the weekend. Then that report comes out, gave a bit of optimism, but that has been faded. European futures then currently flat. FTSE 100 futures pointing to losses of 0.1%, despite the fact that Brent is up 2% so far in the session. DAX futures, though, pointed to gains around 0.2%, looking to add potentially 42 points as we count down, of course, to the open. Anna, what are you looking at?
Yeah, let's have a look at some sectors and some stocks that are firmly in focus for us this Monday morning. There's a lot to pick through, a lot to choose from this morning. Let's go to the chip stock sector first. This has been an area of huge momentum over recent days, weeks even. We're watching the US session, the Asia session. It's been pretty positive. NASDAQ futures have faded a little, but we have seen some enthusiasm for the sector continuing through the Asia session, so we'll watch what that means for Europe. Airlines in focus. The Axios report is one thing. Does that put upward momentum on them? But we've got the oil price. That puts downward momentum on them. We've also got a lot of talk about maybe US airlines trying to get some sort of support from the US government. Is there an expectation that catches on here in Europe, perhaps? E.on is also in focus in the energy space. The German utility is working on a plan to merge with OVO Energy, according to some UK media reports, guys. So we'll watch that.
A lot of single stocks to price in. The broad narrative, though, is energy prices are higher. That should maybe benefit what we are seeing in the FTSE 100 with some of the names out of the UK and France maybe benefiting from that. Does that mean we get a flat picture? Probably yes. At the get-go this morning, maybe we've got weakness elsewhere. We'll break it down in just a moment from a sector point of view, but at the moment, a very flat open here in Europe. The divergence between what is happening in the United States and Europe, really interesting at the moment. Does that widen? Does it close? That's one of the trades that I think people are watching very carefully at the moment. The CAC is up by 0.3%. The Stock 600 gets driven a little bit higher on the back of that. The IBEX is up by 0.1%. The Amsterdam market, though, interestingly enough, we'll take a look at tech in a moment, is down by 0.3%. We'll see what the DAX does in a second. How does this break down from a sector rotation point of view? Let's find out. Tom.
Top of the list right now in terms of your sectors, with the gains coming through for retail, up 0.4%. In an otherwise, as you say, flat market on the headline basis. Travel and leisure is also there, second best performing sector so far in this session, up 0.4%. On the downside, biggest losses coming through for personal care, down 0.5%. For F&B as well, food and beverage down 0.5%. Chemicals, utilities, media, all of those sectors are in negative territory. Travel and leisure is now the top gainer, just 0.4%. Again, in an otherwise lacklustre market. Of course, this is an event-driven, the risk events for this week, given the Strait of Hormuz, the earnings story, and the central bank action. All of those event risks on the horizon. So maybe that is speaking to the slightly placid approach taken by markets so far this Monday morning.
Yes, I'll add one mover in there, and this is in the grocery space here in the UK. Sainsbury's double downgraded at Goldman. Citi is also cutting its expectations for that particular grocery store. So we see that one down by 4% today. So that's putting some downward pressure on that part of the market. Interesting that travel and leisure is moving higher. When I last looked, it was more the leisure side than the travel side, although there is a bit of upward movement in airlines, which is interesting given oil prices are up another 2% this morning.
They were called sharply higher earlier. Ryanair, I think, has just opened flat in terms of what it's delivering this morning. It's up by 0.5%. But I saw a call earlier that it was going to be up sort of circa 6%, which now looks a little off in terms of what we are seeing there. Elsewhere, what do we see as the narrative? That Sainsbury's story is certainly having a big effect. I think there's some XD in the market. I think Axios gone XD this morning. But there is a bit of a chip story to the upside, but maybe not that much of one. Siemens is up a little bit, Infineon's up a little bit. So there is a bit of sort of tech/energy in the mix.
We seem to be entirely flat on the Stock 600, don't we, this morning?
I'm desperately.
Yeah, we're trying to find some more interesting things than that to say. Well, the DAX has just opened up by 0.3%, so there we go. That's a little more interesting. Patrick Armstrong joins us, CIO at Plurini Wealth. Patrick, very good morning. Nice to have you with. So, what is your guiding investment view right now? We've spoken to one guest who seemed not relaxed about the recession risk in Europe, but saying, it's not here yet, and another guest who says there is recession risk building. We'll be in a really stagflationary environment and a recession in Europe in a month if the Strait does not reopen. Is that what's in the driving seat for you, or are you just all about the tech stocks?
That's the main risk you want to worry about is stagflation, because that's a consequence of the war in Iran. The longer it drags on, those risks do grow. And the backdrop to that, you want to own companies with pricing power. That's how you win in the stagflationary environment. And I think it's the oil and gas companies, primarily the refiners. I think they'll have incredible pricing power on refined goods, jet fuel, diesel. And the high bandwidth memory is just insatiable demand right now. They're not expensive. They've got great momentum and incredible growth. So I think those areas, pricing power for different reasons. One because of scarcity, one because of incredible demand.
Okay, so lots to pick through there. Lots of thoughts on those market dynamics. Let me start with what you're saying about what's going on in the Middle East, because you say we've moved on from a binary phase where it's either, war or peace. We could end up being caught in somewhere in between for quite some time, could we?
That's how the market seems to react. It's peace, the market jumps up, it's war, it's going to continue, it sells off. And I think we're in a stalemate scenario endgame where neither side is conceding, but Iran wants to drag it out. They've got to win through patience, keeping hope that there's a deal there to keep the U.S. side from really escalating things. But
and the market could really ignore that if it weren't for the Strait of Hormuz.
Exactly. It could completely ignore it, but it can't because of the Strait. And that's the scenario that I think is missed, that you've seen inventory drawdowns in oil. Everyone knows about that. But on refined products, you're getting close to no inventories left. And I think we have months and quarters ahead of us where there has to be an inventory rebuild with probably a very strong demand backdrop sticking in. And the market's not pricing that, especially in the futures curves.
Patrick, when does demand destruction become a problem for your call and your exposure to the energy heavyweights?
I don't think it's anywhere even close. Probably another 20-30% upside, and you'll see material impact. But
20-30% upside to prices?
Yes, on refined products particularly. People don't change their habits. Companies don't change their habits in the short term until it really bites. And I think where we're at right now, it's hurting, but people are looking through it. They're viewing it as transitory and not really making long-term decision changes. Short-term, people never change things. So I don't think we're at the point where there's been incredible demand destruction.
And your call on high bandwidth memory, that is it's a pretty consensus call, Patrick. Yeah. So how do you convince me that you have confidence that has further to run? And if I'm just wanting to get exposure now, is that an opportunity? Is this about holding the positions you have or adding at this point?
I would be comfortable to add if I didn't have. I would want to own them. Just because when you look at equities, humans have always looked at growth, profitability, momentum, and these stocks have all of them. They don't look expensive because the earnings have outstripped the share price. Share prices have rallied massively. Earnings have outstripped that. In terms of revisions, price momentum, growth, profitability, it's incredible. High bandwidth memory is a commodity. Eventually, there'll be too much of it and pricing will fall off a cliff. But I don't see that happening through all of 2027. The outlook that's going to come this week with the spend on the hyperscalers, I don't think there's any change in that. And the choke points for AI right now is high bandwidth memory and electricity. And I do think it's just incredible pricing power, probably for another year and a half on these stocks.
Okay. When do I fade that?
It's
because the market looks forward.
Yeah, it does.
When does the cycle?
So if Microsoft and Amazon show hesitance on their capex, if the market punishes them for capex, I think that's when you probably want to start to fade them, because you'll have a window where the end of the world, that cliff that we're talking about, isn't priced. That's when I'll probably want to change my mind. And there's been no slowdown in the narrative from these companies. They are 100% committed to their AI data center build-out. And while that's in place, the high bandwidth memory stocks are the beneficiaries.
Can we talk about the market's mental health? How do you, in a world where Trump is moving the market around, can you make rational decisions? How you get to the office on a Monday morning, you look at kind of what is going on. You got an Axios report. How are you, from a kind of, how are you dealing with this? Anna talked earlier about the fact the market's exhausted. Do you feel exhausted? What's going on?
It's exhausting if you do change your mind on everything he says. And what we've decided to do, which might not be the right decision, is ignore a lot of it, because we think the end game for everything he does is he wants quick wins, and the consequence of the quick wins is inflation, in my opinion. So everything he does, he wants to create growth, he wants to end a problem, throw money at things.
So you're just short-circuiting and going straight to the inflation bit?
That's where it ends up, I think. All of these policies are knee-jerk reactions, quick wins, consequences going to be big deficits, big debt, and higher prices in the future. So it helps us look through a lot of the noise, but he is the most important man in the world. He drives markets. And maybe it's a risk to ignore him, but I do think everything he does and everything he thinks about goes in that direction.
OK, so if you're trying to look through some of that short-term volatility and focus on where this takes us, inflation being one of those things, join the dots then with your gold view, because you like gold miners, Patrick, and explain that in that inflation context.
Well, gold is a traditional store of value. It preserves value in an inflationary environment. I just don't have a strong view where gold goes, but every day gold stays at $4,800 an ounce. These companies that have cash costs of $1,500 to $1,900 an ounce, it's just incredible profits. And if there is upside in gold, and there's a really strong narrative that's pushed gold to where it is, that's totally intact. The gold miners are a geared play on that. If gold does nothing, I get incredible profits. If gold moves higher, I get a geared play on it. There's a lot of downside if gold does fall, but I definitely prefer the miners to the gold itself.
Bitcoin's up 12% in the last 30 days. Do you like Bitcoin, Patrick?
I don't have a view on Bitcoin, to be honest with you. Maybe I'm too old to understand
isn't it just a tech play?
It's a correlation with that, definitely.
It's risk aligned now with tech, it seems, at least in the last 30 days.
I think in the last 2 years even. If the NASDAQ futures are up, Bitcoin futures are up, or Bitcoin prices seem to be up.
That's the correlation.
So what do I do next? I remember last year you told me that you thought the market was basically hanging its hat on the idea that rate cuts were coming.
Yeah.
Rate cuts looks like they're not coming. Do you think they're coming?
I do.
Okay, you do?
I think Warsh gets nominated, and I think he'll set the stage for why he has to cut rates, and all the oil price shock is transitory. We have to look through it. I'm not Trichet. I don't hike rates based on current inflation. I don't look at spikes in inflation.
How does the market react to that?
Market rallies on liquidity. So bond prices should fall and stock markets should rise, actually, in that scenario, I think. But it's not certain. He's got a dovish bias. I think that supports markets, and that means you do have the put option when things do go bad. Then he's got the narrative to really cut rates aggressively that I think he's minded to do.
Bond markets take that in their stride, Patrick, or bond markets have a bit of a freak out worrying about
They should freak out.
Inflation fighting.
I don't know what they'll do. But if the Fed cuts rates and the backdrop's like it is right now, we're not in a recession. Growth is still strong. I think the U.S. is going to grow probably a little bit more than 2% this year. Consumer demand looks pretty robust, and prices are nowhere near the Fed's target. They're above them. So that's not the backdrop you should be cutting rates. But I do think he'll be minded to do it.
Do you think the ECB should be cutting rates?
Cutting rates?
Yeah. If we're going to a recession here.
We have to ask you both now, cutting, hiking, everything.
Because if they had a dual mandate, yes, but they don't, so they won't. But I do think we're going to end up with a pretty dovish commentary where they don't want to be cornered into the hike that the market for some reason is expecting.
Great to see you. Thanks for stopping by to see us this Monday morning. Patrick Armstrong, CIO of Perimi Wealth. This is what the Core 6 looks like. This is the picture we find ourselves with at the centre of gravity here in Europe. ASML is a little down this morning, so it's interesting to see how that's translating. Nestle's also a little softer. Elsewhere, there's some fantastic pieces being written about kind of what fashion is telling us about where we are in terms of the economic cycle, and the 80s are back and all that kind of stuff. So pay attention to what is happening. The skinny versus wide jeans debate. Apparently it's a useful market indicator.
This is what Guy Johnson's been reading over the weekend.
Apparently.
The skinny versus the wide jeans debate.
Andrea Felstead has got a great piece out on it this morning. Anyway, Charlie Wells, I'm sure, is all over that debate as well. What do you got, Charlie?
Good morning. So definitely more on the skinny as opposed to the baggy trouser debate here, at least for now. But let's see if that changes. Really interesting mover this morning. That's Nordex. So that is the German wind turbine company. They are up over 10% this morning after delivering an earnings report that beat expectations. Now, this is interesting, right? Because it gets at that kind of conventional energy versus new energy debate that we've been having over the past really year or so. There have been questions about renewables, but given what we're seeing out of the Middle East, it's looking like we're seeing strong demand for these, renewable energy companies. And that kind of gives a boost to Europe, right? Because there is a lot of strength. There are a lot of these large renewable energy companies here. So let's take a look at another story interesting this morning. That is Sainsbury's, the supermarket chain, in the red, so down over 3%. Now, Sainsbury's facing really difficult headwinds. They got that double downgrade. They got some downgrades coming from the likes of Goldman and Citi. Now, the issue here really is pricing, right? Because in the British supermarket sector, as any shopper on the high street knows, there is intense competition. So where does Sainsbury's fit? Where does Sainsbury's fit between, say, a Waitrose and an Aldi? So they're going to have to really fight to keep their margin, to kind of fend off competitors in that ultra-competitive space. And it's pricing that really came up in a lot of these notes in these downgrades for Sainsbury's. So expect pressure there. That is a read also on the consumer under pressure, given some of the inflationary fears, not just inflationary, but also stagflationary fears that we've been talking about over the past few weeks. So definitely one to watch, and the market is not liking those downgrades. Let's end on Whitbread, because this is a really interesting British company as well. So they own a number of hotels. And what we heard, at least according to a report over the weekend, is that they're thinking about offloading some of their Premier Inn hotels. Not all of them, but a swath of them. Now, this would be really interesting for Whitbread because it would make it more of a leasehold company as opposed to a freehold company. And that would free up some cash for investors. So the market is liking the news on that report of Whitbread potentially letting go of some of these hotel chains.
Charlie Wells, thank you very much indeed. Coming up, we're going to check back in on what is happening in the energy space. Of course, oil higher in the session today, gaining after efforts to resume US-Iran peace talks, of course, remain stalled. We know that. That is a fact. There's some reporting from Axios as well. But the reality is the standoff continues. The latest on the market next, and how the energy markets are adjusting to that news. This is Bloomberg.
Welcome back. This is the opening trade, Monday the 27th of April, in fact, and European equity markets pretty flat overall. We do see a little bit of upside coming through on the DAX and on the CAC 40. The FTSE 100 is flat right now, but oil is certainly not flat. Oil is bouncing.
It is bouncing. We're currently trading on Brent at 107. We did earlier see oil pair some of the gains that we've seen. This after an Axios report suggested that Iran has offered the US a proposal to reopen the Straits of Hormuz. Global markets awaiting further news on that. Remember that the Strait is still closed. The high on the year is 112 on Brent. We're currently trading at 107. Of course, these are paper prices. Let's get a take on what happens next. Bloomberg oil and shipping reporter Waylon Sun joining us now to talk about this. The market once again looked at an Axios report this morning, but this morning had a slightly different reaction, and that is it looked through it, and prices have just gone higher again. Are we now in a reality dawning phase where there is a belief now that oil prices are going to go higher, that the Strait is going to remain closed, and that we are therefore going to see Brent maybe taking out that 112 high?
Yeah, right. Because we think that the market is trading on a lot of ceasefire headline news. And this morning when we read about the Axios report, it sort of brought a little bit of optimism back into the market. But if you go deeper into that news article, it says that Iran will only proceed with the ceasefire talks if the US lifts the blockade. So we've been here before. This kind of tit-for-tat mutual standoff has been in place for a few weeks now. It appears that even though Iran is trying to reach out to the US, the way they're proceeding ahead doesn't seem to bring the negotiations any much further. And therefore, you see oil prices gaining again, because for every day that Strait of Hormuz doesn't open up, it gets even harder to get physical barrels out into the market.
What is the current situation in the Strait? There are reports now that 57% of all the production out of the Persian Gulf has essentially been sidelined as a result of this. The standoff continues. To your point, what is anything moving at all through the Strait right now?
What we're seeing right now is just other forms of commodities, say dry bulk or even cargo ships. But for crude and from oil products, it's really difficult to get them out, because what we have are two blockades in place. Iran trying to control the Strait of Hormuz, not letting Western affiliated vessels through. And then the US on the other side, near the Arabian Sea, trying to stop Iranian vessels going out. And this standoff is making some forces in Iran getting even more agitated. And that's why we saw quite a bit of chaos in the Strait over the past few days. And the US has said very clearly that they're targeting the high-value oil tankers. And this just cuts off Iran's revenue. And I think what we can see here now is that Iran is responding by firing on ships, warning them again that we don't want ships going through. And that's why we see the Strait of Hormuz is now at a standstill 3 months on.
So Wayland, what does that mean then for what's on the horizon for energy markets? Goldman Sachs talking about upside risks to their forecasts because as a result of the closure, they see the lowest ever global visible inventories. What is your Bloomberg? What are all your Bloomberg screens telling you about inventories?
Our team over the weekend have reported out a story saying that oil traders are looking at maybe a billion barrel loss of supply currently. We don't feel that as much yet as of now because countries are releasing stockpiles of oil, but we are starting to feel it more acutely in Asia, especially in the petrochemical sector, because once the refineries in Asia, which are geared and built towards processing Middle Eastern crude, if they can't get that feedstock, you can't get your jet fuel, you can't get your diesel, you can't get your kerosene out from those refineries, and economies will start to slow down, cut down demand, and this is where we see demand destruction coming. And once that cuts down, it's likely going to impact on a wider scale in the weeks and months to come.
Thanks very much, Wayland. Good to have you on the programme. Bloomberg's oil and shipping reporter Wayland Sun joining us there with an update on the oil markets. Now, we're also watching Adidas shares this morning after a record-breaking London Marathon. Kenya's Sebastian Sawa ran in the brand's new ultralight $500 racing shoe as he surged ahead to win in 1 hour, 59 minutes and 30 seconds. And breaking that 2-hour barrier is seen as very significant. A new world record as well. We're joined now by Bloomberg's consumer reporter Tim Lowe, based in Munich. So the record it's a huge win for these road racing shoes and this innovation. I mean, I'm not sure how much is to do with the shoe and how much is to do with the runner in it. I could wear, Tim, shoes that cost $500 and I don't think it'd make me go that fast. So give us the lowdown on what this means for Adidas.
Sure, you're absolutely right. Now, I think a lot of people are going to be going out and buying these shoes to see if they can improve their personal best time at all. And that's what Adidas is certainly hoping for. This is sort of like the culmination of decades of talk about whether anyone could really break 2 hours in the marathon. And, the latest chapter is Nike sort of accelerated this game last decade when they introduced really the first generation of these, they call them super shoes. They have super light and bouncy foam. They have carbon fiber in the sole that kind of acts as a propeller. And Nike put on these, events. They didn't count for world records, but Eliud Kipchoge, a Kenyan, did break 2 hours in 2019. It's just that it was not a real race. And so people have been wondering, when is it going to happen? Will it ever happen in a real race? And people have gotten close. And yesterday, the Adidas shoes blew the doors off. 2 guys got under the 2-hour barrier. And they happened to do it in these shoes that Adidas had released on Thursday, so just a few days ago. And they are the lightest marathon racing shoe ever. They're less than 100 grams. And they contain all the latest in terms of technology. The foam is super light. They have carbon plates in them. And so this was sort of like someone has landed on the moon, and they did it in Adidas shoes.
Yeah, less than 100 grams. Is that per shoe or for both? Less than 100 grams. You just wonder how far this tech goes. Adidas have obviously invested in the R&D around this. I'm going to give some credit to the producers because this is the question: how far will Adidas run with this victory? See what they did there with this victory lap of publicity, Tim?
That's a great question. Now, Nike has historically been very good at this game, and they did it in the last decade. What was remarkable is Nike really owned the sub-2 story, even though they had no one that had done it in a real race. So now Adidas has actually had 2 people do it in a real race. So the onus is on them. It does come in the context of Adidas has been like trying to play catch up in this, like the sport of running is booming in the sneaker industry. Adidas clearly has some very high-end products, and the question is whether they can convince the rest of us to buy Adidas in hopes that we'll also get a little bit of that magic touch.
Okay, Bloomberg's Tim Lowe. Thank you very much indeed. We may all be revisiting our sneaker or trainer closet maybe and looking to update as we want to add some speed on the track. Guy Johnson's definitely going there. Coming up, no more robot hallucinations, malfunctions, and maybe hallucinations as well. These machines can actually think outside the bot. Wow, the producer's on fire today. They can think outside the bot. Is this a factory floor game changer? German robotics software company Sereact's co-founder and CEO Ralph Gould is going to join us next. This is Bloomberg. Happy Monday. This is the opening trade. We are 30 minutes into today's session, so possibly not a great surprise, given all the risk events on the horizon this week, that you are flat across the benchmark. You've got Iran, you've got earnings, of course, and you've got central bank action. The DAX is outperforming marginally, so up 0.3%. In terms of what's happening on the CAC Garant, you're looking at gains of just 13 points. On the downside, interestingly, despite the gains coming through for energy, which was the leading sector the last time I checked, with Brent up about 2% in the session, the FTSE 100 is actually flat at 10,373 over the last 30 days. The FTSE 100 has underperformed its European and US counterparts. Guy, what do you see?
Tom did really well then. He made a market that is basically doing nothing this morning sound quite exciting. And to be honest, I don't have much that I can add to that. If you look at what you're seeing in terms of the distribution, you got 264 up, 320 down. The only thing I will add is that volume is kind of galactically light this morning. So the market, that's a theme that continues. And this is an average, remember, so in theory things are getting worse. In terms of the single stocks, actually I think there probably is a little bit of excitement here. So let me just talk you through some of the stocks that I think are interesting. Nordex is definitely one of them. The win story this morning is certainly a win. Nordex is up by 11.4% on the back of its earnings this morning. That is a positive story. Siemens is up by 2%. Rheinmetall, the defence space, is actually having a little bit of a more solid day today here in Europe. So that stock, defence has actually had not a great run recently. On the downside, I think the only interesting takeaway this morning is, despite the fact that we saw very strong numbers out of Asia overnight, it did fade a little bit. ASML is up by 1.4%. I do wonder whether the Asian trade was more of a reaction to Friday's US trade. And this morning, this is kind of a fresh look at what the narrative looked like. So ASML is down, Prosus is down as well. And Sainsbury, a big downgrade this morning for J. Sainsbury. That stock is down by 3%, Anna.
Guy, let's have a look at some of the other stories that we're covering this morning. Iran has reportedly given the US a new proposal to reopen the Strait of Hormuz and end the war. This, according to an Axios report, which cites a US official and 2 people with knowledge of the matter. It says that the offer calls for extending the ceasefire to allow time for Washington and Tehran to work towards a permanent end to fighting. Budget airlines are reportedly working together to ask the White House for a relief plan. This, of course, in the United States. According to the Wall Street Journal, the proposal asks for $2.5 billion in exchange for convertible equity stakes in the carriers. And in tech news, DeepSeek is slashing prices for its newly released flagship model, intensifying competition across a Chinese artificial intelligence industry that is trying to take on Silicon Valley. The AI lab is offering a 75% discount to developers using the DeepSeek V4 Pro and is reducing fees across its family of AI platforms to 1/10 of their original pricing. Tom.
OK, let's stay on AI and shift the focus a little bit to robotics, because there's been a big bet on smarter robots. Germany's Sereact just pulling in $110 million to push the boundaries of what machines can do on their own. The Series B funding round was led by venture capital firm Headline. Sereact co-founder and CEO Ralph Gould says most of the new funding will be used to build out the company's newest AI model, which can help a machine simulate different outcomes and decide what action to take next. I'm pleased to say that Ralph joins us now. Ralph, thank you for your time. Congratulations on the raise. Just give us more details on what this $110 million can do for the company and how it sets you up in terms of building out those partnerships and building out the models.
Hi, Thomas. Thanks so much for having me today. It's a pleasure to be here. So we are really thrilled to announce this fundraise, and clearly what we are going to allocate the funds on is our latest AI model called Cortex 2.0. The great thing about Cortex is that it is grounded in real-world industrial deployment. It's basically a world model that is trained on over 1 billion of real pics. No simulation data, but real-world data. And with the proceeds of the funding round, we are now unlocking this new model that is able to anticipate outcomes when it basically reasons about the environment to solve a robotic task. Similar like humans, it can predict the world's outcomes and thereby is able to do better robotics manipulation. But let's make an easy example. When humans basically go grocery shopping, they stack a bag of groceries and then they wouldn't probably throw a can of soda onto a bag of chips. And this is an easy example of how our robots are able to anticipate outcomes by understanding the physical world and thereby delivering better manipulation capabilities.
You have your software working in robots for the likes of BMW and Daimler. What is the pace with which you are seeing industrial companies adopt these solutions, and what is the biggest challenge you have to overcome when you're making the pitch? What is the key question or the key level of skepticism that you have to get through to get these companies to adopt?
Yeah, great question. So the key question is, can the robot adapt to new environments and to kind of edge and corner cases? What happens when something isn't in place? Is the robot able to generalize and leverage the experience it has onto new and unseen scenarios? And thereby we can say the Sereact Cortex model has the leading generalization level out there in the industry. And that is based on the fact that we have actually trained it on the world's largest real-world robotics data set. Sereact has a data and performance advantage because we have the world's largest robotics fleet out there at real customers, at real production site. Over 200 systems working through real orders, over 200 robots working through real orders 24/7 and thereby generating a large amount of data. It is a clear thing that physical AI has a data problem. Unlike ChatGPT, for instance, we couldn't train a robotics model on an internet of data. Like the biggest problem clearly for physical AI is the lack of data. And Sereact is bridging that data gap by basically combining customer value creation, robots that do useful things, and thereby acquire the data. And because of that, because of Sereact has collected over 1 billion picks in real environments, our model is able to generalize so good and can deliver full productivity from the first day.
Ralph, where is the biggest use case for these robots? Is it in industry? Is it elsewhere? Is it in the home? Where do you think the biggest use case will ultimately be?
That's a great question. I'm glad you bring it up. So at Sereact, we don't try to solve all the problems at once. We are basically starting in easier use cases with a more controlled environment, such as industrial applications, pick and place in warehouses, working in manufacturing facilities. And then we have our robotics brain emerging from industrial application and then generalizing into service industries to do store replenishment and ultimately healthcare and household environments.
Yes, and on that subject, Ralph, when do they make it into the home? Give us a year. When do you think that happens?
This is Anna's obsession.
No, I think that's a fantastic question. It's hard to put a time frame here, but what we're already doing is working with warehouse grocery customers. So that means our robots have picked like hundreds of thousands, even millions of groceries already. And then, of course, getting robots into the home, we have a huge head start already. But for the household environment, I think the humanoid form factor needs to be advanced a bit more. And then we are ready to roll. Maybe one thing that is worth discussing is that at Sereact we don't focus on the hardware per se. We are strong believers that the biggest unlock is the AI. So therefore, the Sereact brain, the Sereact Cortex brain, can empower all kinds of form factors.
I feel like I need a Sereact brain this morning. Ralph, how many jobs do you replace as a result of this technology ultimately?
I wouldn't necessarily say that we are replacing jobs. I would say we are augmenting humans. What does that mean? One of the greatest challenges humanity faces at present is the demographic change. We have a problem or a challenge of vanishing labor, and we need to increase our productivity to remain competitive. So therefore, our only solution for humanity is to leverage robotics automation to overcome labor shortages and to have sufficient productivity and capacity in healthcare, in household, and also in industrial applications. So Sereact brain empowers robots so that the robots can do ordinary tasks and humans can focus on the extraordinary things.
Ralph, thank you very much. Thanks for joining us. Great to speak to you, the Sereact co-founder and CEO, Ralph Gould. Let's stick with technology innovation. Quantum computing is widely considered a potentially transformative technology for finance, with the capability to add billions of dollars in revenue. However, it currently remains largely experimental with limited real-world use cases. And that's left some of the world's largest banks split on whether to invest further or cautiously wait and see. We're joined now by Bloomberg Finance reporter who's been writing the Big Take story, co-writing the Big Take story for today, Will Shaw. Will, nice to have you with us. So, Will, what are the big Wall Street banks doing then to harvest the potential of quantum computing? Let's start there.
So this dynamic's best understood by looking at Goldman Sachs and JP Morgan. Both banks, more than 7 years ago, began experimenting with quantum computing, what it might do. Now, about 3 years ago, Goldman Sachs were looking at how they could increase returns for their wealthy clients through quantum. They were surprised, to say the least, to discover that it would take their algorithm millions of years in order to solve this problem. The team was disbanded shortly after during a wider cost-cutting program, and Goldman has remained on the sidelines ever since. JP Morgan is taking a very different approach. They've still got about 50 mathematicians, physicists, computer scientists working on problems about how quantum might help with portfolio optimization, cryptography, machine learning. So they still remain very committed to what it might eventually deliver.
You've boiled it down to JP Morgan versus Goldman Sachs. Is Goldman Sachs just representative of most banks? are most banks in the Goldman Sachs camp, or are most banks... JP Morgan's enormous and it has a lot of capacity to do these kinds of things.
Yeah.
Most banks, I'm assuming, don't.
I think it's fair to say that JP Morgan is the exception rather than the rule. Yeah. It's easier to figure out how quantum can help in areas like life science, chemicals, defence than it is in finance. That's because there's such a myriad of problems that people are trying to address in finance. That includes transaction fraud, risk management, predicting asset classes. Most banks are largely staying somewhat on the sideline, given how long it might take in order to deliver on the promise of quantum computing.
Can you give us a bit more detail in terms of that promise then, Will? And why would they not look just to buy in solutions rather than employing armies of mathematicians and quantum wizards? Why not just buy it in from an external source when the technology is mature enough? And where is the potential most significant upside for these banks longer term?
So they are relying on a lot of auxiliary firms, tech startups to help them with this. They're not working purely in isolation. Now, their goal largely is, if we look at McKinsey's findings from last year, they talked about how by 2035, quantum computing in total might deliver about $72 billion in revenue. That compares to about $4 billion in revenue in 2024. So people are committed. They are working to some degree in areas where they see potential benefits. So you have firms like UBS, they're training up about 50 quant analysts in the basics of quantum computing. Credit Agricole, they're looking at how quantum computing might assist them in spotting potential credit downgrades. Like I said, though, this remains, it's not like AI. You're not seeing the level of investment, the level of interest, the identification of potential in the same way that you are with AI. I think firms broadly recognise there'll be years of work before anyone sees a big payoff in this area.
It's a really interesting read, though. Thank you very much indeed for bringing it to us. William Shaw, who co-wrote today's Big Take on your Bloomberg terminal. Coming up, traders warn the worst of the oil shock is yet to come. The Strait of Hormuz remains effectively closed. We're going to get the latest on the potential ceasefire talks. That is coming up next. This is Bloomberg.
Welcome back to the opening trade, 8:47 in London, and European equity markets very much flat across the top line. We do have some movement under the hood. The DAX is up by 0.3%. The AEX over in the Netherlands down by 0.6%. So we do have some movement, but overall we're flat. And I guess it makes sense because we have such a busy week ahead of us, don't we, with the corporate earnings agenda looking really full, lots of central banks, and that says nothing about the geopolitics.
Let's talk about the geopolitics. The Iranian foreign minister, I think, is in Moscow now. The meeting with Vladimir Putin. Talks with the US, apparently between the Iranians and the US, remained at an impasse. So where does that leave us this Monday morning? Jabana Basetchi joining us from Dubai with the latest. Talk to me about the implications of this trip to Moscow.
Yeah, well, it is a notable one, Guy, and especially because it's coming on the heels of this weekend of a whirlwind tour that the Iranian foreign minister has spent throughout the region. He visited Islamabad twice. He went to Oman. This morning landed in Russia, and he is supposedly going to be meeting with the Russian President Putin in a couple of hours. And here, it is interesting to see that Russia is having such a high-profile meeting with the Iranian foreign minister, given everything that's gone down, especially because Russia, in this instance, are not a neutral mediator. There have been multiple reports of them having shared both intelligence and surveillance support with the Iranians in their bid to track down key U.S. assets in the region. Also reports of them sharing key technology and possibly even weapons as well. And so there's an interesting angle that is opening up here, not least because economically, Russia is emerging as one of the key beneficiaries of this war as well, with higher oil prices and that temporary lifting of the sanctions waivers from the U.S. But what is emerging from this whirlwind diplomatic tour that the Iranian foreign minister has conducted is the ask and the conditions that the Iranian side are putting forward in order to proceed with discussions with the U.S. And this is more, it sounds like more like a wish list as opposed to conditions that the U.S. are going to accept, including a new protocol around the Strait of Hormuz, war reparations, a lifting of the U.S. naval blockade. And at this point in time, of course, even though there's plenty of pressure from nations around the world to lift the blockade, the mutual blockades that are in place, there's no signal from the U.S. side that they're planning to do so. Yesterday, President Trump in a Fox interview actually said that the blockade is going well, and in a couple of days' time, what will happen is you're going to start seeing that Iranian storage capacity reach its limits, at which they expect the Iranian side to come to the negotiating table and make more concessions. So at this point, it's unclear whether the U.S. are actually going to subscribe to the conditions that the Iranians have set forth. And there was a lot of talk this morning about maybe this being a breakthrough of some sort. But we've yet to hear from the U.S. Axios are reporting that there will be a situation room briefing later this afternoon. But once again, it is unlikely to yield the breakthrough, the big breakthrough that the market is expecting. What we do understand, though, is a better sequencing of how the events could be in terms of, number one, thinking about what they're going to do about the Strait of Hormuz before, two, proceeding on to the bigger topics around the nuclear file, the nuclear program, the funding of proxies, and Iran's ballistic weapons arsenal as well.
Yeah, and we'll be watching, of course, to see if there is any further reaction from President Trump and his team later today. Bloomberg's Jumana Pasechi in Dubai following that visit as well by the Iranian foreign minister to Russia. Jumana, thank you for that update. Let's take a look at what else we are watching throughout the week. Later today, King Charles arrives in the US for a 4-day visit. On Tuesday, the BOJ rate decision kicking off the big central bank action, of course. On Wednesday, you've got the Fed rate decision. You've also got US tech results from Alphabet, Meta, Amazon and Microsoft. A huge day for earnings, particularly on the tech front. And on Thursday, central banks back in focus with the European Central Bank and the BOE coming through with their rate decisions.
So what are we focused on? It is a massive week. Skylar's here. She's going to tell us what we should focus on. Skylar Montgomery-Koenig joining us from our M Live team. What's the most important thing you're watching?
I mean, it's still the oil price for bonds in particular. Okay. For equities, not so much. Yeah, I think, well, this is it, right? The transmission channel is you have higher energy prices. That feeds into growth and inflation. The central banks then respond to that, and the bond market responds to the economy and what the central banks are doing. And so your signal of what the central banks are going to do is coming from the real-time variable of energy prices, because there's enough of an impact that there will be that feed through. Now, I'm not a geopolitical analyst, so I have no idea actually what's going to happen from that perspective in terms of negotiations this week. So we just have to kind of watch. If we just range trade throughout the week, then bonds maybe can range trade, and we'll take signals more so in that case from central banks.
Skylar, as you were talking there, we saw Brent go over $108 a barrel, some sort of messaging. So in terms of the central banks then, the most interesting ones, the Bank of Japan, I think, could be interesting because up until so recently, we'd been expecting a hike, actually, hadn't we, from the BOJ? Then there's a lot of talk about how, no, they won't hike, maybe they'll hike next time. Where do you think the interest will fall in terms of the central bank conversations?
Yeah, I mean, Bank of Japan certainly, because the expectation before the war was they would be doing hikes regardless this year, and they very much react to volatility and uncertainty. And so they kind of just freeze when that happens, which is why a hike isn't expected at this meeting, but there's something like 16 basis points priced for June. And that could be quite dangerous for the currency if you have more dovish soundings from them, if they're more concerned about the growth impact from higher energy prices than the inflation impact. That could see dollar yen rapidly go above 160 and bring up risks of intervention. So that's very important from a signaling perspective of what comes next from them, because hikes were expected and now they've been pushed out.
On the equity market story, we're speaking to Mark Downing of Blue Bay Asset Management at the start of the show, and he was saying he thinks that there should be a wider divergence between US equity performance and European equity performance. The other side of that, I guess, is S&P 500 up about 10% over 30 days. The Stock 600 is up about 4%. So you do get that divergence. Mark thinks it should be wider. How do you think that story unfolds in the days and weeks ahead?
I mean, I think it absolutely should be wider, particularly in the current environment where you have energy prices very high. That's much more negative for growth in Europe because Europe is an energy importer versus the US being an energy exporter. I also think you had outperformance of European stocks last year that wasn't necessarily warranted by the relative earnings picture. And going forward, you have a higher tech weight in the US, which is what's powering earnings and equities higher. You also just have this perspective where AI adoption rates, for example, are higher in the US than they are in Europe. And if you think that leads to productivity, it should be long-term outperformance on that. So I think there are a number of things that are skewing that way and will likely continue to.
Why are people buying tech? Is it because they like tech? Is it because tech's a great place to hide out? Is it because everything else looks rubbish and tech's the only thing where you can actually kind of make a case for the... It's a really confusing picture at the moment in so many ways, why you're suddenly getting this rapid move to the upside. Is it just momentum? Is it... what is it?
It is really confusing because last earnings season as well, we had really good results for tech companies and they didn't do particularly well because people were quite scared. I think it's partly a repositioning of that because you're not finding growth stories elsewhere because you're more worried about growth overall because of higher energy prices. And you can say these companies are generating growth now that is slightly independent of that. Yeah. And I think it's partly a catch up to that and a catch up to valuations had adjusted lower. And these are, the valuations are higher than elsewhere. But the reason you have higher valuations is that U.S. tech companies have just been more profitable over the last decade. Yep. And if that continues, there's not a reason that you shouldn't adjust up now that they're cheaper post last earnings season.
Skylar, just briefly, scenarios seem to be catching. All central banks are about scenarios now. The ECB was about scenarios. The Bank of England set to be about scenarios around the Strait of Hormuz. What should we expect from the BOE?
Yeah, the Bank of England is also a really interesting one, as well as the Bank of Japan, because they have a vote on hikes and cuts, etc. And you could see a couple of members vote for a hike at this meeting. And we've had a big shift in expectations for them, right? We were expecting 2 cuts prior to the war. The market's now looking for more than 2 hikes. So if it gets validated, bonds could be under significant pressure there.
Yeah, and that would be tough for the UK economy. It could be a pretty uncomfortable decision even for the Hawks on the BOE. Skylar Montgomery, thank you very much. Indeed, Skylar Montgomery-Koenig, of course, looking ahead to a huge week of earnings and, of course, the central bank action. You look at gilt yields now up about 2-3 basis points, largely in line with what we're seeing in the European bond action as well. Across the stock picture, you're just seeing very, very soft, a little bit downside now, down to 10% on the benchmark, having futures flagged earlier positivity, but that's been wiped out.
US futures flat to negative now, Guy.
It's going to be a mess. Today just feels like the calm before the storm, doesn't it?
Huge week.
Huge week coming up. The Pulse is up next. This is Bloomberg.